Well, right now I'd like to start some of the chapters that I refer to them more of applications chapters. So in this particular chapter, as the title says, we're going to talk a little bit about interest rates, but we're going to start the ball off by talking a little bit about long-term financing, and in particular what are referred to as bonds. So what is a bond? A bond essentially is a loan. Like most loans, it has a face amount or a principal. It's repaid at maturity. For a vast a vast majority of corporate debt and government debt, bonds have $1,000 par value. So essentially a bond represents a loan of $1,000. The coupon or interest rate is the interest that's paid by the borrower. When you go to buy a car, the bank says you have to pay 5.7% on the loan. That is the interest that you have to pay on the debt. That is what's referred to in a bond as a coupon interest rate. It is a fixed rate. It's stated, it doesn't change. And to find out how much you pay, you simply multiply the par value by this rate and you get the interest payment. Now, when debt is typically issued in the very beginning, companies try to match the coupon rate as closely as they possibly can to the yield to maturity or the returns that investors want. And I think this makes sense. We'll talk about these a little bit later, but if the yield is what the investor wants, then it makes sense that the company has to try to issue debt that pays interest for what they want. Unfortunately, though, time changes, so it may take 6 months or longer to get a bond issued to the market. So interest rates could have changed in the meantime. So they're going to try to be very close, but they don't always hit the target that they're looking for. All bonds are loans, so they have maturity. They mature somewhere out in the future. Typically, a larger corporate bond is going to have a maturity value of 30 years. There is some debt that is very, very long-term, though. I've seen bonds issued for 50 years. There's bonds that have been issued for 100 years. So the yield to mature, or the maturity, is when the bond actually becomes due. The yield to maturity can be described a lot of different ways, I guess. But I essentially like to think about the yield to maturity as it's the rate of return you get if you buy this bond and you hold it to maturity. Now again, the bond market, it's the required rate of return for investors to receive with interest or with coupons or investments like this that have similar risk and maturity. So all bonds that have the same kind of risks and maturity should have the same yield to maturity, and investors want to receive that. When we calculate value, again, we're going to use the time value of money, of course. We need to know the discount rate. So ultimately, this is the discount rate. Again, we've usually talked about this at issue. We try to get the coupon rate and the yield to maturity to be very close. And it is always quoted as an APR. So the yield to maturity is going to be 15%. The process that we're talking about is something called valuation. And this is a process that links together risk and return to determine the worth or the value of an asset to someone who wants to purchase it. The key ingredients, we need to know something about the cash flows. We need to know something about the timing of those cash flows. And in the end, we need to have a measure of risk, which helps us to determine the required return that investors want to purchase that asset. We have a basic bond valuation formula. It is a summation of present value calculation. So the value of any asset is the present value of all of its future cash flow. Of course, what that does is that assumes that we can forecast accurately what these cash flows are in the future. So the cash flows is the CF. R represents the required return on the investment. N is the relevant time period when this cash flows occur. We have some basic investment rules. The first basic investment rule says if the value of an asset is greater than or equal to its price, we would want to buy the asset. Now here's where the analysis comes into play. Everybody knows what the price is. You know the cost of assets. So we have to solve for value. That is what we're ultimately trying to develop in this chapter, is how do we find the value or determine the value of a bond. The second rule is if the expected return is greater than or equal to the required return, we buy the asset. Again, the expected return is something we need to calculate. It's the return that if we buy this asset at its current price and the cash flows actually occurred, that's the return that we're going to receive on this investment. So we have to calculate that. The required return is a number that reflects risk. Now with bonds, we're going to talk about both of those. We're going to talk about how you calculate them, what they mean, what the terminology reflects, etc. So here we have a company. We have the Fresh Food Enterprises. They issued a 10% coupon bond. It's a 10-year bond with $1,000 par value. So if you buy this bond, what are you going to receive? How do you get your money back? Well, every year it's going to pay 10% of $1,000, so you'll get $100 a year in interest. And also, at the end of the 10th year, you're going to receive a $1,000 check that represents the money that you loan to this company. So if you assume that interest is paid annually and the required rate of return is equal to the bond's coupon rate, what is the ultimate value of this bond? I mean, that's essentially what this course is all about. So before we actually get into that math and answer those kinds of questions, let's explore a little bit further some of the characteristics. The value of a bond is the present value of its cash flows plus the present value of its principal or par value. These are two simple time value questions. What's the present value of an annuity payment? And what is the present value of a lump sum? Let's keep this in mind as we go through here, because we understand now how time value and values change. As interest rates increase, present values decrease. So when the required return goes up, the present value goes down. As interest rates increase, bond prices decrease. And interest rates increasing, bond prices decrease. That's essentially what this rule states. And it's what obviously brings it into focus, the relationship between the time value chapter and this chapter. So let's go back to the bond. How do we calculate this? If you look at the spreadsheet, right, we're going to go to the bond valuation spreadsheet. You click on that spreadsheet. Let me make it a little bit bigger here for us. We can calculate the value. So we had what? It was a 10% interest loan. We said the yield was 10, time was 10. Let me delete this here for a second. And what you can see here is that, of course, that the par value or the bond value is $1,000. So you would be willing to pay $1,000 to purchase this investment. The corporation wants to borrow $1,000, so this exactly equals what the bond the borrower wants to receive and what the investor is willing to give them. So one of the challenges we have, though, is we have to understand a little bit more about returns in general. So let's go down and talk about returns. The yield to maturity is the rate of return that you earn if you buy the bond and you hold it to maturity. This assumes that the issuer makes all the scheduled interest and principal payments. So if you get everything you expect to get from this bond, this is the rate of return you'll get over its lifespan. If you have a current price that's equal to par value, the yield to maturity is always going to be equal to the coupon rate. But when bond values differ from par, the yield rate then obviously is going to be different. If you pay something different than its par value, then your return is going to change. Here we have a bond that takes 10% the interest that's paid, or the coupon. It has a par value of 1,000, 15 years left to maturity, and it has an 8% required return. What's the value of this bond? Well, again, if we go back to let's go back to our statement here. We have 8%, 15 years, right? This bond is worth, as you see right here, is worth $1,171. That's the most you'd be willing to pay. And of course, that's the answer that we got right here. Now, what if you could buy this bond for $1,100? Would you? Well, let's go back here. Let's add it here so we can look at this page. Whoops, 1,100. You pay $1,100 for this bond, and the bond is worth $1,171. Would you be willing to pay $1,100 to receive $1,171? And of course you would. Would you be willing to buy something and earn 8.78% if all you wanted was 8%? And of course, since you're getting more, you would be perfectly happy with purchasing this bond. So this bond, turns out, is a good investment. So let's kind of go back and review now. We know how to calculate the value of a bond. We know how to calculate and understand the yield to maturity. In practice, the value of a bond is hardly ever going to be equal to its par value. The required return can change for many reasons. It can change because of the risk of the company. It can change because of interest rates, etc., in the economy. But there are lots of things that can change that will alter the bond value behavior. Not to mention that time changes. So as time goes on, the value of the bond is going to change because of the very nature of present value. So a representation of this basically says, look, if you're looking at the yield to maturity of a bond, how does that change with different interest rates? So as interest rates in the economy change, right, this yield to maturity can invest. It's what investors want to receive. So as what investors want to receive goes up, we see that bond values go down. So the yield to maturity, the return to investors, varies inversely with bond prices. So let's go back to this bond. What would happen if the required rate of return for this Mills Company's bond rose to 12% or fell to 8%? Well, if it goes from 10 to 12, if the required return goes up, we know the value falls. And since this value is less than $1,000, we say that this is a discount bond. If it went down from 10 to 8, since we know the required return is going down, bond value goes up. Since this value now is greater than $1,000, we say this bond is selling at a premium. Now, I don't want to get hung up by the status over here because it is totally irrelevant to the pricing mechanism. It just merely tells us, compared to $1,000, where is the current value of this stock. So if the coupon rate equals the yield to maturity, the price will equal the par value. And I think this is kind of an easy way to think about this. The coupon rate is what the corporation wants to pay you. The yield to maturity is the return that you want to receive. Well, if they're willing to pay you, the coupon rate, exactly what you want, the yield to maturity, then you're willing to give them, the price you pay, exactly what they want, which is the value of the bond. It's $1,000. Now, if the coupon rate is less than the yield, they're willing to pay for debt, but they're not willing to pay what you want. Now, you may still want to purchase this bond. It still might be a good investment. But since they're not going to pay you everything that you want, you're not going to be able to pay them, or you're not going to desire to pay them everything they want. So in this case, the price will be less than the par. That means it's going to be a discount bond. Again, doesn't really mean anything. It just means that the price is less than the par value. And of course, vice versa is true if the coupon rate is greater than the yield to maturity. So what happens to bonds as time changes? Doesn't matter whether you buy a premium bond or a discount bond. When it matures, it's going to have a value of $1,000. They're going to give you a check for $1,000 that represents the money that they loaned. Now, what is a little curious about this is that the red line up here, this bond up here, has a coupon rate that's greater than its yield to maturity. Down here represents bonds where the coupon rate is less than yield to maturity. Again, it really doesn't matter the situation. Both types of bonds could be perfectly good investment opportunities for us. Let's talk a little bit about this thing called risk. And in particular, we want to talk about the economic risk, which is referred to as interest rate risk. The first part of risk is it's the change in price due to changes in interest rates. So when interest rates change, as we've talked about here, investors want different rates of returns. That's their yield to maturity. So as investors' yield to maturity changes, that has an impact on the price of the bond. Long-term bonds are going to be riskier than short-term bonds because they have a longer period of time for these new interest rates to have an impact on them. Low coupon bonds are going to have more risk than high coupon bonds, mostly because of the nature of the low coupon rate. That is, that the fact that these low coupon rates are typically going to be discount bonds, and they're going to be more sensitive to changes in risk than the high coupon bonds. Reinvestment rate risk is another type of risk that comes when you purchase bonds. Essentially, it talks about what do you do with the cash that you receive in the future. You're going to reinvest that cash. Well, what interest rate are you going to be able to reinvest at? Well, if interest rates go up, that means that future cash flow investments are going to be greater returns. They'll have higher rates of returns for you. And of course, that's good. That's something that you'd want to have happen to you. Short-term bonds have more reinvestment rate risk than long-term bonds. High coupon rate bonds have more reinvestment rate risk than low coupon bonds. So the riskiness of this component, of this reinvestment rate risk, is dependent on the time remaining and ultimately the coupon rate on bonds themselves. So let's take a picture of a couple of bonds here and see what's going on. We have 2 years. This is a 1-year bond, right? And this 1-year bond, if we're looking at different, the value of a 10% coupon bond, this is interest rates in the economy. And really the only thing I wanted to show you here is the 30-year bond is a curvilinear, or has a curvilinear function, and it has a steeper slope. So since it is curvilinear and a steeper slope, then it is more risky than what the 1-year bond is, which has a rather low slope, hardly any slope at all, and looks like, at least apparently, is a very straight line. So again, that's the basics of the mathematics of bonds. You'll find a couple of videos that will help you understand what's going on in a little bit more detail, so you can practice a little bit with the math. In the meantime, let's go on and talk about some characteristics and terminology with respect to bonds. There's a difference, obviously, between being a creditor and an owner. Those are all outlined here, right? Of course, creditors do not own anything. They don't vote. The interest that's paid to them is tax deductible. If there's no, if the creditor, or excuse me, if the borrower doesn't pay on their debt, they have legal recourse, so they can force insolvency if they don't pay. On the other hand, shareholders, they own the company. They get the vote. Their dividends are not tax deductible to the corporations, right? So dividends themselves are not a liability until they declare them. So in other words, the corporation has no obligation to pay a dividend at all. And again, an all-equity firm can't go bankrupt, right? If you don't owe anybody any money, you cannot go bankrupt. There is a contract that's signed that between the issuing company and the bondholders. It sets out the terms, the amount of the bonds issued, the types of security or collateral that's used, any kind of sinking fund provisions. Do they set money aside so that when it comes time for the bond to be due, that there'll be money there to pay? They also said if there are certain kinds of provisions within the bonds. Could it be callable debt? Do these bonds have any type of a conversion feature? So again, we're going to talk about some of these as we go on here. Bonds can be what are referred to as registered or bearer bonds. Essentially, a bearer bond doesn't have your name on it. So anybody that has that piece of paper is the owner to that piece of paper. So you have to be very careful with the security of those kinds of debt. Registered bonds, though, that piece of paper has a number, and that number is tied to you. Certain bonds have security or collateral, right? We have mortgages that can be used. We can use other assets. We could use investments and securities, etc. A debenture is a type of a corporate debt that is unsecured. There's no collateral. So there are collateral bonds and there are unsecured bonds. There are secured and unsecured, collateralized bonds and debentures. The idea of this thing called seniority basically means that debt has an order, if you will, of how they're going to be paid off. The senior debt gets paid first, followed by junior and or subordinated debt following that payment. We've talked about the coupon rate. You know that usually it's the yield at issue, but it doesn't change. It's fixed. So let's think about this. Which bonds will have a lower return if all else is equal? Would a secured bond that has collateral have a lower return or a higher return than debenture? What I want you to think about to answer this question is, how risky is the debt? If it is more risky, it will have a higher return. Secured debt has collateral, so it's less risky, so it will have the lower return. A subordinated debenture is paid after all the senior debt, so it's a riskier position, so it would have a higher level of return. A sinking fund means the company's going to squirrel away some money so you can be sure to getting your maturity value when it comes due. That's obviously less risky having a sinking fund than not. So it's going to have a lower return. And in the end, we're going to talk about something called a callable bond. And essentially, we'll talk about that a little bit later, but think about this. A callable bond says that the company can force you to do something you don't want to do. And that's never good for you. So since it's not good for you, you're going to want a higher rate of return. So that's the end of chapter part 1. And it's a pretty long chapter. There's a lot of detail here. So take your time. You may want to read the book a couple of times. Make sure you watch the videos. They're very helpful in driving home some of these points. We'll see you again in part 2.